Hello, my name is Omar Sawaf. I'm a real estate lawyer and broker, and I'm also the founder of Direct from Developer. Today, we're going to talk about investing in U.S. real estate. Now, the U.S. is a big place. It's 50 different states. They all have different laws governing real estate. They've all got different real estate dynamics. So it's difficult to paint with a broad brush, but we're going to try to give you some of the basics. But before we begin, let's start with the threshold question: why invest in the U.S.? And there's some pretty good reasons why. The U.S. has the highest gross domestic product in the world, over $15 trillion. The U.S. has world-renowned cities like New York, Washington, D.C., and Miami, and Los Angeles. There's strong capital appreciation and rental returns in some major markets. The U.S. has a stable and secure economy, and there's more foreign money flowing into U.S. real estate than anywhere else in the world. Now, today's discussion is going to cover three broad topics. We're going to talk about financials. How is U.S. real estate performing? Then we're going to talk about the law. Can you, as a foreign national, buy in the U.S.? And what vehicle are you going to use for that purchase? How are you going to structure that purchase? And finally, we're going to talk about taxes. What taxes are going to touch on you as a foreign national investing in the U.S.? Starting with financials and starting with rental yields. Rental yields vary significantly by location. You can achieve an 8% net yield in some secondary U.S. markets. I think of the Detroits and Clevelands, for example. The primary U.S. markets offer weaker yields. So New York's, you're looking at a net yield of, say, 3%. Los Angeles, San Francisco, Seattle, Boston, 4% net yields. So if you're looking for a yielding investment, you're going to probably look to these secondary markets. In terms of property price performance, residential property price performance, prices are rising but vary by location. So, for example, Orlando, Florida, in the year 2018, you had a 10% increase in prices. Tampa, Florida, 10% increase in prices. New York City, 7.8% increase in prices. Detroit had a 6% increase, and Chicago had a 3% increase. So prices are on the rise, but vary by location. How are you going to finance the purchase as a foreign national? Well, according to the National Association of Realtors, the majority of overseas buyers do all cash deals. Cash buyers can save time and money on loan-related fees, which is a good thing. Now, loans are available to foreign nationals on deposits of anywhere between 30% and 50% of the purchase price. Some banks do have minimum deposit requirements or have caps on loans, but we're seeing banks are beginning to loosen the underwriting requirements. And I think we're going to see more people, foreign nationals, financing their purchase. And there are a lot of specialty lenders that specialize in this area. So moving on, closing costs. What costs are you going to pay when you buy property in the U.S.? Well, buyer closing costs often equal about 1% to 2% of the total cost of the transaction, so of the purchase price. So that's pretty low relative to other countries. Transfer taxes or stamp duties will often be the largest expense you're going to have to pay. If your buyer finances the purchase, you're going to have some additional financing charges that may apply, which including like lender fees and lender title policies, a lender title policy, an appraisal. And costs are going to vary by location, so keep that in mind. In terms of the law, the U.S. is a financial safe haven, and you've got low risk factors investing here. So you've got no capital controls or expropriation risk. Foreign ownership is permitted with rare exceptions. Property is fully transferable, and rights are enforceable in the courts. Starting with that threshold question, can you as a foreign national buy U.S. property? The answer to that question is yes, you can, with minor exceptions. U.S. citizenship, residency, or green card are not required. You as a foreign national will need a tax ID number, which is a tax processing number, and it's readily obtainable. In terms of, well, there are some other laws that touch on foreign ownership of property that either impose limits or requirements for foreign purchasers. And I include this slide for completeness. If you are a specially designated national on the Treasury's Office of Foreign Asset Control sanctions list, you're not buying U.S. real estate. In terms of residency, property ownership is not linked to residency. So simply buying property somewhere in the U.S. does not give you the right to enter the U.S., doesn't give you the right to reside in the U.S., doesn't give you the right to citizenship. Property ownership will not qualify for an EB-5 visa. EB-5 requires your investment to be at risk, and there's a job creation requirement associated with that visa, neither of which are satisfied by simply buying property in the U.S. Now, there's a couple different ways you're going to structure your purchase in the U.S. You can buy it, and again, this list isn't comprehensive. You can buy it in your own personal capacity. It's easy, but the privacy concerns in the sense that your purchase will be in the public records. You also have personal liability concerns. If it's an investment property, you're leasing the place out, you're personally at risk. And there's also a state tax risk, which we'll talk about in a second. You can also buy through a limited liability company, which is better, at least with respect to personal liability. There's limited liability to the members of a limited liability company. It's easy to establish, limited governance. Ownership, the members' ownership isn't public generally, so you're not going to be in the public records. The members' names aren't going to be in the public records, but the members will have to file tax returns, and there's potential reporting requirements to the beneficial owners of the LLC. There are income tax advantages through buying through an LLC, whether it's a disregarded entity or it's essentially two or more members are part of the members of this LLC and it's taxed as a partnership. You're going to have one layer of tax, which is a good thing. But there's still potential estate tax exposure, which makes it suitable for smaller investments, but maybe not for bigger investments. One structure I do like is the blocker structure. Here you have a domestic corporation that's formed in the U.S. You have a foreign parent company that wholly owns this domestic corporation, the U.S. domestic corporation, and you have foreign shareholders that own the foreign parent company. Here you've got limited liability to the foreign shareholders. The foreign corp and its shareholders do not file U.S. tax returns, although the domestic corp will file a tax return and have potential reporting requirements. The foreign shareholders' shareholding, it remains private. It's not in the public records. There's no estate tax exposure here, so you've got this is why it's called a blocker structure. The foreign corporation ownership of the domestic corp by the foreign corporation blocks the application of the estate tax, which is a good thing. The income generated from the domestic corporation is taxed at a flat rate of 21%. That's 21% of the net rental income, and that's been reduced from 35% before the Tax Cut and Jobs Act of 2017. So now you're only going to get taxed, the domestic corporation is going to be taxed at 21% of the net rental income. So that's income minus deductions, 21% on that remaining balance. And there's still potential exposure to two levels of tax under this structure, subject to treaty reduction, but I still think this is a great structure. If you buy property in the U.S., the terms are going to be set out in a sales contract. That contract will be in writing, and it's going to set out all the key terms, the purchase price, the deposit, inspection periods, title issues, title insurance, and other fundamental terms of the transaction. Risks and costs are going to be apportioned between the buyer and seller in this contract, so it never hurts to have a lawyer involved. On breach by the buyer, the seller often retains the deposit. Breach by the seller, the buyer usually gets the deposit back and can potentially bring a claim for damages. In terms of due diligence, when you're buying property, you're going to research the seller's title or have an agent research it for you. Good title is often insured by a title insurance policy. You want to have the property inspected by an inspector, check out the property's condition, check out the appliance's condition, certificate of occupancy. If it's a rental property, you're going to investigate the leases because chances are you're going to take subject to those leases, and you want to make sure that those leases are solid, have terms that you're satisfied with. In terms of the logistics of the closing, physical attendance is not necessary when you buy property in the U.S. You can grant power of attorney to an agent who can act on your behalf. This is quite common and convenient for buyers who do not want to attend the closing in person. The person could be perhaps your broker or a lawyer. The buyer must be prepared to pay the purchase price at closing, whether it's their own funds or partially paid by a lender if you're financing the property. And closing is often managed by an escrow agent or title company. In terms of lease agreements, if you are buying property as an investment, chances are you're going to lease the property at some point. Leases that have a term exceeding 1 year must be in writing, and lease agreements are going to set out all the material terms, the rent, the renewal, the term. If you've got disputes with your tenant, chances are you're going to end up settling the dispute through the local courts, unless it's subject to an arbitration clause. Your lease has an arbitration clause, and again, eviction proceedings, all that generally is going to be settled through your local courts. In terms of red flags, I don't see a lot of red flags in investing in the U.S. That's probably why it's so attractive. Supply-demand risk can always be an issue, particularly in those major markets like in New York City where there's new supply coming online. But again, one of the great things about America is it's such a big country that oftentimes there are a lot of hidden gem cities where there's not new supply always coming online and there's really good opportunities. Finally, taxes. What taxes are going to touch on you as a foreign national investing in the U.S.? Well, 4 primary taxes I'm going to talk about today. Well, actually 5. The first is transfer taxes. And this varies by location. They're often less than 1%, and they're assessed against the sale price, relatively low compared to other investment hotspots, including Hong Kong, where you have a foreign buyer's tax of up to 30% of the purchase price, Toronto, where there's a tax of up to 15% of the purchase price on foreign buyers, and Vancouver, where you have a transfer tax, a foreign buyer's tax of 20% assessed against the purchase price. So relatively competitive. The U.S. does not punish foreign buyers when they're buying in the U.S. So relatively reasonable transfer taxes. You're also going to have a property tax, which varies by city and state. It's approximately 1 to 2% of the purchase price on an annual basis, assessed against the value of the property. And again, it can exceed 2% in some markets. Think of like a New York City. But again, property tax is pretty standard, approximately 1 to 2% of the purchase price or the value of the property. Then you've got income taxes. It's an income generating property. If you're renting it out, you're going to pay federal taxes on that income. Potentially state taxes, unless you're in a state that doesn't have state taxes. I think of Texas or Florida. And you're going to have city income taxes. In some states, in some cities, you're going to have a city income tax. Most cities do not have an income tax, but some cities do. I, again, think of a New York City. Foreign nationals can elect to be taxed on a net income basis on their federal income taxes. That's income minus deductions. So you're only getting taxed on that difference. You take your gross income, you subtract all the deductions, and you're just taxed on that net figure. Foreign nationals can often greatly reduce or possibly eliminate their taxable income in their early years, since deductions, including depreciation, offset that income. So again, you're only taxed on you make this election, you're only taxed on your net income, which is a good thing. Individuals and owners of pass-through entities, like an LLC, taxed as a disregarded entity or a partnership, those pass-through entities and individuals are taxed at individual rates. Under the current code, you're paying rates of 10% on the low end and 37% on the absolute high end of net taxable income. So it's just on that net figure, that net income that you have after deductions. 10% on the low end, 37% on the high end. And hopefully, if you've only got a few properties and you've got a lot of deductions, you're hopefully going to be close to that 10% rate just on your net income. Domestic corporations pay a flat tax of 21% on net taxable income. Again, that's income minus deductions. Your domestic corporation, if you form a domestic corporation and you own through income property through that domestic corporation, you can pay tax at a flat rate at 21% on net taxable income. Coming to capital gains, when you sell the property, gains from the sale of U.S. real estate by a foreign national or a foreign corporation are taxable. And it's a two-step process. In the first instance, you as a foreign national, you sell your property in the U.S. The buyer has to withhold 15% of the gross sale proceeds, and remit it to the IRS. So, with minor exceptions, if you, as a foreign national, sell your property, it's $1 million condo, you sell it for $1 million, the buyer has to withhold $150,000 and remit it to the IRS. Now, you might say to me, well, listen, that doesn't seem fair. I bought it for that same property for $1 million. My tax base is $1 million. I'm selling it for $1 million. I've got no net gain. I didn't make any money off this transaction. And you'd be right. The IRS understands that. So what you can do is you can get your accountant to seek a withholding certificate, which basically avoids this gross withholding on the 15%, because you've got no net gain. And if you're granted the withholding certificate, this 50% gross withholding won't apply to you. Alternatively, what you can do, and many foreign nationals do, is they file a tax return and they claim a refund of this 15% gross withholding, or a portion of it, and ultimately, if assuming they're taxed at long-term capital gain rates they've held for the relevant holding period, they'll get taxed at anywhere between 0% and 20% just on that net gain. The difference between what you paid for it, assuming you paid $1 million for this property, that's your tax basis. That's what you paid for it, and that's your basis. You sell it for $1.1 million, so there's a net difference, a net gain of $100,000. You can get taxed at anywhere between 0 and 20% just on that $100,000, that net gain, assuming you're taxed at long-term capital gains rates. So Again, not hugely significant. Ultimately, you're just getting taxed on the net gain from the sale if you file the tax return. Domestic corporations pay a tax at a flat rate of 21% on the net gain of the sale. So in my previous example, you had the property, the corporation bought the property for $1 million. That's its tax basis. It sells for $1.1 million. They'll pay 21% a flat tax rate on that $100,000 gain. So in my example, you'd pay a tax of $21,000. Moving on to the estate tax. I mentioned this a couple times as a trap, something you want to avoid as a foreign investor. It's really a trap for the unwary and can be totally avoided with some basic planning. For example, that blocker structure I mentioned. If you buy property as a foreign national in your own name, or potentially through a pass-through entity like an LLC, but specifically, again, in my example, you're buying property in your own personal capacity. You are going to end up paying taxes at a rate of 40% on your U.S. situs assets. So all your U.S. real estate, all the real estate located in the U.S., you're going to end up paying tax rate of 40% of it on your death with a $60,000 U.S. exemption. So that's significant. The first $60,000 in value will be exempted, but after that, you're going to end up paying, tax at a high rate, unless you avoid the estate tax altogether. And again, it can be done with some basic planning. Again, surrounding yourself with the right people can make a world of difference. And that's it. If you have any questions, you can always reach out to me at Omar from directfromdeveloper.com. You can also reach out to us at our corporate headquarters in the U.S. Or check out our YouTube channel if you're interested in investing in or being introduced to property in other jurisdictions. So thank you so much. I hope you learned something and have a great day.